Have you ever wondered how to earn $10,000 a month in dividends? Well, wonder no more. We are about to embark on a fascinating journey that will unravel the mysteries of dividend income. This isn't about quick riches, but about building sustainable, long-term wealth. Imagine a life where you earn money while you sleep, where your investments work tirelessly to generate a steady stream of income. Sounds intriguing, right? Over the course of this video, we will explore 5 different methods to achieve this very goal. We will delve into the world of high dividend yield stocks, navigate the landscape of real estate investment trusts, understand the power of dividend growth stocks, unravel the potential of preferred stocks, and finally, explore the stability of bond ETFs. Each of these avenues offers unique opportunities to earn substantial dividends. So buckle up and prepare to dive into the world of dividends. The first method to earn hefty dividends is by investing in high dividend yield stocks. Now you might be wondering, what are high dividend yield stocks? Well, they are shares in companies that deliver a large portion of their profits back to shareholders in the form of dividends. This yield, expressed as a percentage, is the annual dividend income per share divided by the market price per share. So if a company's stock is priced at $100 per share, and it pays out $5 in dividends over a year, then the dividend yield would be 5%. The higher the yield, the more dividends a shareholder can expect to receive relative to the stock's price. Now let's imagine that you have $1 million to invest. If you were to sink that into stocks yielding an average of 12% annually, you'd be looking at monthly dividend income of about $10,000. Sounds enticing, doesn't it? But as with all investments, high dividend yield stocks do come with their share of risks. Companies that pay high dividends could do so because they're in financial distress. They could be trying to maintain a high stock price to fend off investors' concerns. Also, high dividends can sometimes mean the company is not reinvesting its profits back into its business, which could limit its future growth. That said, the benefits of high dividend yield stocks are clear. They can provide a steady stream of income, and they can be particularly attractive in a low interest rate environment when bonds and other fixed income investments are yielding little. Investing in high dividend yield stocks also offers the potential for capital appreciation if the stock price increases over time. This means that not only can you earn income from the dividends, but you could also make money if you sell the stock for more than you bought it for. In conclusion, high dividend yield stocks can be a goldmine if you know how to invest wisely. Just remember, it's important to do your homework before investing. Understand the company's financial health and dividend payment history to make the most informed decision. Method number 2 is investing in real estate investment trusts, or REITs. A REIT is a company that owns, operates, or finances income-generating real estate. They're designed to provide a way for individual investors to earn dividends from real estate, a space that's traditionally difficult to break into without a hefty amount of capital. You see, REITs operate under a unique business model. By law, they're required to distribute at least 90% of their taxable income to shareholders in the form of dividends. This requirement often results in higher dividend yields compared to other types of investments, making them an attractive option for income-focused investors. Now let's talk about the potential earnings from REIT dividends. The average yield for REITs has historically hovered around 4 to 6%, but this can fluctuate based on a variety of factors, including the health of the real estate market and the specific sector of real estate the REIT is involved in. For instance, REITs focused on industrial properties or data centers may yield different returns than those focused on residential or retail properties. But with potential reward comes risk. The value of a REIT can decline just like any other investment. Plus, because REITs are tied to the real estate market, they can be impacted by changes in property values, interest rates, and market demand. However, there are benefits as well. REITs offer a way to invest in real estate without the need to buy or manage properties yourself. They also provide a level of liquidity that owning physical real estate doesn't offer. You can easily buy and sell shares of a REIT on the stock market. So to sum it up, REITs can be a potentially lucrative way to earn dividends. They offer a chance to dip your toes into real estate investing without needing to become a property mogul. And remember, as with any investment, it's important to do your research and understand what you're investing in. REITs can be a solid source of regular income if you're savvy about your investments. The third method involves putting your money into dividend growth stocks. Now, for those who might be unfamiliar, Dividend growth stocks are shares of companies that routinely increase their dividend payouts. These are not just any companies. They are typically established, profitable businesses with a history of sharing their success with shareholders through ever-increasing dividends. So, how does this strategy work towards our goal of earning $10,000 a month? Well, let's dive into it. If you invest in a company with a solid track record of growing its dividends, the yield on your original investment can increase over time. This is because the dividend yield is calculated based on the price you paid for the stock, not its current market price. So, if you bought a stock at $50 per share with a 3% yield, and the company increases its dividend by 8% annually, in 10 years, your yield on cost could be close to double. But like any investment, there are risks involved. Companies can cut or eliminate their dividends at any time. This is why it's crucial to choose companies with a history of dividend growth and a sustainable payout ratio. You also need to be aware that dividend growth stocks may not provide the same level of current income as high-yield stocks, but they offer the potential for income growth over time. The benefits? Well, investing in dividend growth stocks can provide a hedge against inflation, as companies often increase their dividends at a rate that exceeds inflation. Plus, these stocks can offer more stability than those of younger, less established companies. To get to our target of $10,000 a month, you would need a substantial investment up front. But remember, the power of this strategy lies in the compounding effect of growing dividends over a long period. In a nutshell, dividend growth stocks can be a powerful tool in your investment arsenal. They require patience and a keen eye for quality companies, but the rewards can be substantial. Dividend growth stocks can provide a steady stream of income growth over time. Our fourth method is investing in preferred stocks. Now you might be wondering, what are preferred stocks? Well, these are shares in a company that come with a fixed dividend. Unlike common stocks, which offer variable dividends, preferred stock dividends are set in stone. This means if you own preferred stocks, you'll receive a fixed amount of money regularly, making them a more predictable form of investment. So, how do preferred stocks differ from common stocks? The most significant difference lies in the dividends. Preferred stockholders are first in line to receive dividends before common stockholders. This gives you a higher claim on the company's profits. However, preferred stockholders usually don't have voting rights in the company. It's a trade-off between higher, more predictable returns and having a say in the company's decisions. Now let's talk about potential earnings from preferred stock dividends. The amount of money you can make from these dividends depends on the fixed rate set by the company and the number of shares you own. For instance, if a company sets a fixed dividend rate of 5% and you own stocks worth $10,000, you'll receive $500 every year. That's a pretty decent return. However, like all investments, preferred stocks come with risks and benefits. The biggest benefit is the predictable income from the fixed dividends. On the downside, preferred stocks are more sensitive to interest rate changes. If interest rates rise, the value of your preferred stocks might decrease. Additionally, although preferred stockholders have a higher claim on dividends, in case of bankruptcy, creditors and bondholders are first in line to claim the company's assets. So, what's the takeaway here? Preferred stocks can be a great way to earn a steady income from dividends. They offer higher and more predictable returns than common stocks. However, they also come with certain risks that you need to consider. Preferred stocks can give you a higher claim on dividends, making them a potentially lucrative investment. Last but not least, our fifth method is investing in bond ETFs. Now, what exactly are bond ETFs? Think of them as a collection of bonds that are traded on an exchange, much like stocks. They bring together a variety of bonds, which could be government, corporate, or municipal, into one easy-to-trade package. The magic with bond ETFs lies in their ability to generate income. How? Well, bonds within the ETF make regular interest payments, which are passed on to investors as dividends. So, by investing in a bond ETF, you're essentially buying a slice of these interest payments, which could potentially add up to $10,000 a month. But of course, as with any investment, there are risks. Interest rates can fluctuate, impacting the value of your investment. However, the beauty of bond ETFs is their diversification, spreading risk across various bonds. Bond ETFs can offer a reliable income stream, with the added benefit of diversification. Now that we've explored these 5 methods, you're well on your way to earning $10,000 a month in dividends. Let's do a quick recap. Firstly, we dove into high dividend yield stocks. These are shares in companies that pay out a large portion of their profits as dividends, offering a steady income stream. Next, we ventured into the world of real estate investment trusts, or REITs. which give you a piece of the lucrative real estate market without the need to buy properties. We then discussed dividend growth stocks. While these may not pay out as much initially, their potential for growth is substantial. Fourthly, we looked at preferred stocks. These are a bit like a blend of stocks and bonds, offering higher dividends than common stocks. Lastly, we touched on bond ETFs, a more stable option with regular interest payments. Remember, all investments come with risks. Make sure to do your research and invest wisely. Here's to your financial growth.